we may not finish it. So I'll leave that till tomorrow. That Palema, that's the Palemo Temidayo. Maybe we'll look at that tomorrow. You may read it ahead of tomorrow. However, I'm giving you 2024 to go and solve. If you don't solve, you will see it. You will see it in your exam. You will see it. You'll be shocked. Question 1, 2024. It will come out. I don't solve it now. Just leave it. Okay, just hold on now. No worry yourself. I know where that particular question is coming from, that 2024. I know where it's coming from. And that's why I'm saying go and solve it. And one thing we'll do again is May, ma? May. And we have just 1 month.
Chris.
Yes, ma.
No, I say prophet, Mr. Chris.
Yes, so you don't know I'm a prophet. Yes, look at question. There's one. Look at question 26. La Limited. La Limited. If you're there, I am there. La Limited. L-A-V. Bashorun La. Okay. Illustration 2. This is question 26, and that's May 2017, question 3. Let's quickly run through. La Limited, a food packaging company, has operated as a private company for the past 10 years. The company has been growing rapidly over the last few years. The directors are now considering listing the company on the stock market. Preparatory to this, the directors are interested in determining what are the reasons why you think a company should value their business or value their company. Why? What are the reasons for valuation? For listing, yes. For liquidation, yes. For diamond estate, to determine the value of estate, yes. Merger and acquisition, yes. It seems very simple, Abi. Wait till you see it first. Okay. You remember that? Okay. Preparatory to this, the directors are interested in determining a fair price per share for the company. Assume today is when? November 1st, 2016. The following information has been extracted from the most recent audited financial statement of LA Limited. Statement of profit or loss, October 31st, 2016. Figures assumed correct. Sales revenue, cost of sales, EBITDA, depreciation, EBIT, interest, earnings before tax, and then tax, and then profit after tax. All figures assumed correct. Statement of financial position as at October 31st. Non-current asset, cash and bank, all figures assumed correct up to total equity and liability for the 2 years given. The following additional facts are available. Now, please take note. Every time you're trying to calculate or value a business and the examiner gives you, how do I put it, a comparative balance sheet. The reason why they are giving you that is for you to be able to calculate what? Movement in your capex, movement in working capital, movement in your loan values. And remember, I told us when we started that when you're dealing with free cash flow to equity, because the cash flow you're getting is for equity holders, whatever movement in loan must be adjusted on it. It's only when you are dealing with free cash flow to firm that you ignore that. Are we good? Can we continue? Or I should explain it again?
Again, please.
You remember we have free cash flow. How many are there? Free cash flow. There are two, Abi. You have free cash flow to equity, Abi. And you have free cash flow to what? Firm. As the name implies, that is who owns the cash flow. Free cash flow to equity, the cash flow that is available to who? Only equity holders.
Equity holders.
Free cash flow to firm, available for who and who? Equity plus debt holders. No thinking. So just as the name implies, if this one is available for equity holders only, it means that the suitable cost of capital to be used here should be what? KE. And suitable here, because it's equity and debt, should be what? WACC.
WACC.
Now the issue now is, how do I determine free cash flow to equity? Just to understand it, all those your operational cash flows, all operational cash flows. Remember that interest expense is not an operational cash flow. It is what? Where does it go to? Interest. Finance. It is finance. So number one is when I'm determining free cash flow to equity, if I have interest for that period, one, that interest must be taken out. Because I want to know what is going to be left to who? To only equity holders. Number two is, let's say that I want to get the free cash flow movement for the period. And then I have all my operational cash flows and deducted interest. However, I got movement in my short-term loan. I got loan from maybe an overdraft from the bank. Remember that overdraft should not form part of this. Am I correct? So that means the impact of that overdraft should be adjusted on what? On this free cash flow. Why? Because the cash flow I want to get should be cash flow that belongs to who? Only equity holders. If I come to this place, your mind just go to your NPV. There's nothing about interest, nothing about movement in movement in short-term loan. Why? Because all these are already what? Inside here. This effect is already here. And so just calculate your operational cash flows, your working capital, your net capex, and then discount it using what? WACC, and then you move on. Right. So, where did we stop? Okay, additional facts are available. The directors believe that the free cash flow to what? Equity model should provide what? Appropriate valuation for what? For the company's shares. An investment banker has provided the following estimate of what? Cost of capital. Can you see? They've given you cost of equity, they've given you post-tax cost of debt, and they've given you what? WACC. So they want you to just choose whatever thing you want. What do you think they are trying to do here? They want to test whether you actually know which cost of capital to be used for any of these approaches. If I'm to be doing NPV, for instance, which of these will I use? If I'm to be doing APV, base case, which one will I use here? On gear, Abi. So it means that this KE that they gave to me is not suitable. It's not going to be suitable. What am I going to be doing? I need to look for a way to remove the debt impact from that KE that's given to me. If I'm doing MPV, I'll be using what? That WACC, is that not? Okay, so note 2, the directors believe that the free cash flow to equity will grow by how many percent? 80% for the next how many years? 5 years, and then 5% what? Thereafter. And I told you in the last class, this is what you call staged what? Valuation, where cash flow is growing from one period to another period, it will stop, another one will start. And I told us when you have a stage valuation, what you do is you get the value from year 1 to year n, you discount it, plus value from year n to what? To infinity. Remember that formula I gave us, cash flow into 1 plus G divided by KE minus G, then multiplied by base year discount factor. Can we still remember? Hey. What would they give you? Which formula are they giving you? One thing that you must remember here, before you even start reading, please go to the back of the formula. This thing. Go and write down the formula that I give to you first. Before you start expecting your examiner to give you, do I even call this a cash flow? I mean a formula. Is this a formula? That cash flow into, it's not formula now. And I think when we're doing cost of equity, I explained this thing to us. It's same approach. When you have growth, what do you use? You have G0 into 1 plus G, Abi, divided by KE minus what? Minus G. Is that not the normal value? And I told us how you arrive at that value. So when you discount that cash flow from year, what's it called? Year N to infinity, it brings the value to year N. Don't worry, let's continue. Huh? You carry a spoon. Your add N work. How do I put it now? You want them to delist you. I can use it to shine. You know, they are looking for people to use to shine. They just catch you like this. Your name, your face will be everywhere. You say, wow, I can. Just wait till they catch you first. Eh? Bad publicity. You are not a content creator now. So what do you want to achieve? Okay. Okay. That means you have to start creating content. All right. What did they ask us to do? And then the company currently has how many? 600 million shares in what? In issue. You have to calculate what? The free cash flow available to what? Equity for the year ended when? 31st October and then 2016. And then B, use what? Free cash flow to equity model to calculate what? The current value per what? Per share. Per share. All right. What did they ask us to do? Calculation of what? All right. Quickly, let's go to the question. What are the items we need to consider here? From the statement first, we have the revenue, Abi. What else are we going to adjust on the revenue? There's interest. Now we have to deduct interest, Abi. Why are we deducting interest? For what? Because we are dealing with free cash flow to what? Equity. Fantastic. All right. So first we have revenue. Are the figures in thousand or million? How much is the revenue? 15,790. What does we have? Cost of sales. Now, 13,514. If you take it out, what do you have? 2,276. What else do we have? Oh, there's even, do you have earnings? There are earnings before interest and tax already. How much is that? What do we have between cost of sales? Let's charge those other items. There's depreciation already, Abi. Okay, so I think we should start from there. So we don't just waste time. Earnings before interest and tax. Earnings before interest and tax. How much is it? 1836. Less interest is how much? 3 less interest 330. How much is it? 1506. So this is earnings before tax, Abi. Which one? You can pick from anywhere actually. Before tax. It just most important thing is know what you're doing. And then your tax rate is how many percent? 30. How much? 452. What else do we have? Earnings after tax. 1054. What else do we have? Then we have our depreciation, Abi. Why are we adding back depreciation? Because remember, they've deducted it here, right? Add back. Tax liable. How much is it?
440.
Depreciation is how much? 440.
440.
440. What else do we have? We have a working capital, Abi. So let's go and do this notes. Adjustment. For what? Working capital, Abi. Note what? Note 1. So what are the working capital components that we have? We have 2 years, Abi. We have 2016, 2015, and then we have movement. Is it not? First one is receivable. What else do we have? Inventory. And then we have what? Payables. What's it for 2016? 10. Yes. Or 2, yes. 3084. 2015. For which one? 980. 78. 2792. So movement, if I have inflow and then outflow, Abi, outflow should be in jacket. Receivable, what's happening to the movement? Look at how it's going on. This is 2015. Is it increasing? What does that mean? By how much? 92 outflow. Inventory increasing. What does that mean? How much? 464 outflow. And then payables increasing by how much? 292. What does that mean? Inflow, outflow? Inflow. So we have net working capital. How much? 264. Outflow, Abi. Okay, so let's leave this figure 264. Move it here, 264. What else? What other adjustment do we have? Non-current, Abi. Is there non-current asset? Note 2. Adjustment for capex, Abi. What do you think is happening to the capex? Is it increasing? By how much? How much is it in 2016? How much? 6,224. And then 2015, 5,940. What's happening to it? 282, right? And then we have there's depreciation for the period. Is that? Increasing means what? Are we spending? That's increase, Abby. So we have adjust for depreciation. How much is the depreciation for the period? 440. So total movement, how much? 7, 2.
Mr. Chris, I feel the first one is 284, not 282.
Is it 284?
284, that is the difference between 6,224 and 5,940.
Okay, 4,2, Abby. Like this?
No.
284.
The movement is 284. The difference between 2015 and 2016, that is 284, not 282. The movement, that is the difference.
Okay, which one is wrong now?
282. It's supposed to be 284.
Okay, so
the movement.
Is it correct now?
No, the movement. This 284 above 440 is supposed to be 284, not 282.
What was the figure on the 2015 from your material, from your question?
It's correct, please. It's 5942.
So should this be outflow or inflow? Outflow. Thank you. All right. So we have movements in capex. Capex. Note what? Note 2. How much? 722 outflow. What else? There's liability part, Abby. So we have movement in what? In short-term finance, Abby. Note what? Note 3. So let's go there. So we have which one is first? 2016, Abby. 2016, 2015. So what are they? We have a short-term loan. Overdraft. And then we have, what's the other one? We have treated account payable now. There's bond there, Abby. Value for 2016. Short term is how much? 2004. No.
1936.
Movement, should I just call it financing? Let me put it that way, if that is confusing. In financing. Okay, how much is short term?
1936.
For 2016, Abby?
Yes.
What else? Which one? 1432. This is the movement, Abby. Movement. How about bond? 24 in 2016. And then 2015, 25. So what's happening? Movement for between 2016 and 2015. What's happening? Increase, that's inflow of how much? 504. And then decrease, outflow of how much? 100. Net finance, how much? 404. Inflow, is it? $404. Any other item I've not considered? So we can get our free cash flow. To what?
Equity.
To equity. Egoni. 912. Like this. A million. Please take note of the difference. If this were to be for cash flow to firm, this guy will not be there. True? This interest will not be there. And also this movement will also not be there. Are we together? Interest will not be there. You are doing free cash flow to firm. And this movement in finance also will not be there. And I think I've explained that to us already. All right. So B part of the question is what? What's the A? Free cash flow now. And that's what we have done. What's the B? Okay, so B, calculation of what? Value per share. Using what? Free cash flow to what? Is it to firm or to equity? To equity. Is it not? So let's get the details out. We have our growth from which year? Year 1 to year 4. Is that what they said? Year 5. How many percent? 18%. We have growth from year 6 to infinity. How much?
5%.
Then the relevant cost of equity should be what? Discount rate should be cost of equity, is that not? KE, which is how many percent? 15% given to us, is it not? So now let's calculate. Since the growth rates are staged, the valuation should also be staged. That is, total value equals to value from which year? Year 1 to 5 plus value from which year? Year 6 to what? To infinity. Okay, so let's get our value, year 1 to 5. One to 5, year 1, year 2. Let me reduce this. Year 1, year 2, year 3, year 4, year 5. We have free cash flow to equity as per as in what? A, Abby? As in A, and going up by how many percent? 18%, Abby? So help me grow them now. You grow the free cash flow to equity. This guy, help me grow it. Help me. 912 growing by 18%. Eh? 1076, Abby.
Mm-hmm.
One, two. Hello? Hello? Yeah, Alpha.
1, 2,
And they, I did.
1, 2, 70.
Yes. Where is the person now? And the person should bring it to central area now. Me, I'm at Bratton. My class will end by say anything from 11:30, 12. I'll show in the class. The person is coming from the airport now. Eh? Let the person just come first. The person should just come first. Give my number to the person. He should call me when he lands, when he gets to central area, when he's in front of CBN. But even if he lands, the person is not coming into CBN now. We don't allow him to enter. He's going to be outside CBN. I said I'm at central area. I'm in Bratton. If the person lands, he should just call me. I'll just pick the opinion from the person. And then go to the person is going to come to the front of CBN now. So I'm close. I'm in central area. Let the person just come. I'll get the opinion and then get to the office. All right. Okay. All right. Sorry, guys. Year 2 figure. 70 figure, yes. 1498, yes. 17 MOE, yes. 2086, fantastic. What do we do next? We need to discount it, Abby. Discount factor at what? 15%. Help me. 0.870, yes. 756, 658, 572, 497. Fantastic. I have the present value of my free cash flow to equity. Help me. Figure 936 960 37 987 611. So we have our value from year 1 to what? Year 5. Help me add this together. Figures in million. Help me. Add all of them together. 4930, Abby. So we need to add what? add value, year 6 to what? To infinity. And remember the formula is to the free cash flow to equity into 1 plus G growth to terminal growth rate divided by KE minus G multiplied by discount factor what? Base year. Is that not? So free cash flow to equity, I explained to us in last time. Look at it here. You are picking from the last, these are our base now, Abi. So the movement is going to come from here, 2086, right? So I would have 2086 into 1 plus terminal growth rate, 5%, divided by cost of equity, 15%, minus what? 5%. Now, this is what I was trying to explain to us. The essence of multiplying this by base year is, remember, the cash flow we are picking here, this is cash flow in which year? Year 5, Abi? The moment you do this, it gives you the present value, but you drop it in year 5. Remember, the decision you are making is when? Now, Abi. So it means you have to pick it from that year 5 and bring it to which year? To this year 0. By now multiplying it by what? That discount factor in that year 5. That's why there's this discount factor in base year. So again, I will just multiply by no thinking. Look at the discount factor base year. Now, 0.497. So 0.497. Give me a figure that you call now. Help me. 10,886. So we have total equity value. Help me. 15,816. So they told us value per share, Abi. Total number of shares. How much? 600, Abi. Million shares, Abi. So all these figures are already in millions. So remember, they say value per what? Per share. Don't miss this 0.5 marks, right? And the difference is value per share and total value. So value per share is simply just dividing this 15,816 divided by what? 600. Help me. 26.36 naira per what? Per share. Ogucha. Would you buy no? No thinking. For doing nothing. For doing nothing.
Excuse me, sir. Please, where did you get that 1076 that you used to increase the years by 18% up?
Where did I get what?
This 1076 in year
Grow
1.
this 912. 912, grow it by 18%. This 912 is the valuation as at year 0 times 0. And they said from year 1, excuse me, year 1 is going to be growing by 18%. So just multiply by 1.18. Make sense? What has started?
Yes.
Where? Are we done? Are we done with the question?
No, sir. There's a
What are
C
we
part
asked to
of
do?
that question. There's a C part of that question.
Advantages of what? What are they? Yes. Increases investors' confidence. Number 2, liquidity. Liquidity. What else? Yes. Ease of raising funds. What other advantage? If you're listed, what's your advantage? Global, right? Attraction of institutional / global investors, opens market opportunities to foreign market, etc. What are disadvantages? Difficulty in listing requirement. Right? What else? Possible market infractions and penalties. Right? Like what happened to Zichi shares. A lot of companies that are listed, if you're listed, you become very careful. It's just like when they say you become a celebrity. When you become a celebrity, what happens? You have to be very careful because everything you're doing, everybody is watching. Like Zichi shares move from 1.85 and moved to like 18.5 within just 2 weeks. What did they do? The directors directly, do I say directly now or intentionally, right? Intentionally mop up the shares and then made the share price, very, very scarce. And then the share prices just started going up, and people were buying, investors were buying. And then when NSE caught them, eventually they suspended them. And then investigation is currently ongoing and all of that. So what we are trying to do is it becomes very possible for you to just get away with certain things if you're listed. The reason why that happened actually is because what? Because they are listed and everybody is actually watching them. Next is what? What other disadvantage? Cost, Abi. Listing costs may be high. What else? Time, Abi. Listing takes time, etc. 8 marks. And I hope you know that at this level, you don't just do this like this and move, Abi. Even though you are going to be technically repeating what you have said here. But you still have to do what? Just change it. If you like, use PG to write it. Just change what you have said. Increases investors' confidence. Why will it increase investors' confidence? Because the price is there and all that, listed in the market. And so, say again. Write what? Yes, write pidgin. They don't mark English, write pidgin. Provided that your examiner will understand. If your examiner will understand, it's fine. All right, so we'll be ending this year. So 2 more questions. There's one ACCA question. Yes?
Yes. The possible market infractions / what?
Infraction and penalties.
Okay.
Yeah. When we get to mergers and acquisition, you see, and then there's one thing again that I don't know if I've said it in this class. Regulations, how mergers and acquisition regulation protects, minority shareholder. Don't worry, when we get to mergers and acquisition, we'll talk about that. All right, so 2 more questions to do here. I think that's 20. What diet is that? I said we're going to do it tomorrow. That Parliament, we'll look at it tomorrow, and then also look at one ACCA question, and then we move straight to mergers and acquisition. From there, we move to corporate failure and reconstruction. From there, I think we'll look at bond. No, we need to do bond valuation first before mergers. Okay, after now, we'll do bond valuation. From there to mergers. From there, then we'll see how portfolio, we see how option pricing, we see how risk, foreign exchange. We see us a couple of. We don't have any break coming up soon. Our Muslim brothers, when? March 20, I mean. Please, any break you have, we are booking it ahead now. Tell any lecturer that any break you have is already booked. So the last diet, we did 9 to I think 4. And I did that for maybe 2 or 3 times for us to be able to meet up with timing. Because trust me, we have a lot to still cover. So If you have any break, please. Fantastic. Yes, Brad team is working on that. All right. So, guys, thank you for your time. See you when I see you. I'm not Brad team. Oh. I'm sending the notes now. Hello? Yeah. Who's baby?